Hi everyone, this is Rohan Matthews. I head the international markets here at QuantInsti. It is wonderful to see you all attending this webinar. We have received a lot of and multiple interests and inquiries about how to develop these strategies and how to take it to a platform where they can test these strategies along with multiple indicators for them. Uh, so keeping that in mind, we thought it would be a good idea to get someone with the expertise to take you through these strategies and how we can implement. Um, EPAT and Blueshift, which you'll be introduced to soon, has been sharing this complementing relationship, and both together will help you develop and execute the same on a trading simulator like Blueshift. Our product, our host Pradipta would take you through the next 1 hour and train you how to do this using Blueshift. Now, Pradipta has been with us for some time, and he's a seasoned quant and currently leads the fintech products and platforms development and QuantInsti as a vice president here. He has spent more than a decade in the banking industry in various roles across trading and structuring desks for Deutsche Bank in Mumbai and London, and as a corporate banker with Standard Chartered Bank earlier. Before that, interestingly, Pradipta worked as a scientist in India's defense R&D organizations, which is DRDO. He has been so Blueshift has been his baby, and he knows best how to take your strategies to this particular platform and test those results there. So I would like to take this time and hand it over to Pradipta to take it forward from here.
Thanks, Rohan, for the kind words. Welcome to everyone on the webinar. We'll focus mostly on a few things about backtesting, not all things. Of course, everything about backtesting and strategy development cannot be covered in a single session. Before we do that, very little introduction about Blueshift. Blueshift is a cloud-based strategy development platform. If you haven't tried it out yet, I suggest that you please do sometime after the webinar, hopefully. This is a cloud-based platform that has data sets included in it. Dataset covers US and Indian equity market as well as cheat and forex with minute level data. It also has a strong learning and community that we are trying to develop. And this platform ensures that all the backtests you develop on this platform belongs to you. The IP of all and every backtest belongs to the creator. Anyway, so back to the outline of today's sessions. We'll discuss a very brief few points about systematic strategies in general. And then we'll follow up with a short primer, a very, very indecently short primer on Python. Those of you already are familiar with Python. This will be a couple of minutes wasted, unfortunately. Then we'll move on to a quick introduction to Blueshift, and we'll create a quick reusable template for backtesting on Blueshift. Then we'll have a look at technical indicators, some technicalities about technical indicators. And then we'll create a very simple strategy using a single technical indicators. Then we'll move on to managing portfolio strategies in different manner. This session is not about any trade recommendation. This session is not about giving you the best strategies that always work. There is no such thing. And also, as I said, that we are not covering many aspects of backtesting, especially the precautions we need to take during backtesting. Maybe we can cover it in another session. So the systematic strategy has an entire spectrum depending on the type of traders you are, the style of your trading, and also the type of the market you are trying to exploit. So on the vertical axis, it projects the type of trading styles, and on the horizontal is the kind of trading that you're doing. So if you're talking about fundamental traders, they trade the trending and mean reverting and breakouts and carry and all those event-based strategies anyway. But each one of them, the quants, the technical traders, and the fundamental traders, they do it in different manner. So in fundamental trading, the value investing, for example, is a mean reversion trading. Whereas in terms of quant, the mean reversion trade is usually a pair trading or most form of statistical arbitrage. Whereas for technical trader, the mean reversion trade is usually a swing trade or a retracement or pivot trading type of entry and exit. On the other hand, if you are talking about breakout, the fundamentals, they focus more on relative value strategies. The quants, they focus on advanced modelings like regime switching models or hidden markup models, whereas the technical traders goes for opening range or dual thrust based strategies, or maybe even technical breakout patterns. And similarly for carry and event based. To be honest, technical traders really cannot trade much event based strategies because it is not by nature captured in the past prices. The design cycle for systematic strategy is something like this. You first start with selecting your universe. It depends on what is your capital that you are trading, what is the market you are trading, what is the asset class you're trading, whether you're trading only FNOs, the futures and options, or whether you're trading macro assets like FX and rates and bonds and all. Once you have decided your universe, then the next step comes how to generate the signals. I mean, how to generate the buy and sell signals on this. This also can be of two types. In one case, you take the look at the universe of your securities and generate signal in a manner where the signals are interdependent. So, for example, whether you will buy X will depend both on X and Y and Z and other securities in the universe. On the other hand, it can also be independent. So if you are going to buy or sell X, will only depend on the past prices and the data about X itself. In the first case, you cannot parallelize your trading style. In the second case, you can potentially parallelize your trading, at least the signal computation part. Then once you have developed the signal computation, then the next step is to create the target portfolio. That is basically computing the weights for each of the securities in our universe based on the signals as well as based on your current position. And in case if you have any risk rules or anything else. Once you have decided your target folio, now is the time to execute, which is we call the rebalance strategy, which concentrates all your execution rules and strategies, including your execution risk management. And finally, once this cycle is complete, you know the performance of your strategy, then you get into the continuous improvement cycle. So you research further and refine further your process, your parameters, and then you go back to the same thing. A few points about developing systematic strategies. The first is, of course, inputs. Inputs to strategies are mostly prices and its transformation. So for example, most of the technical indicators are transformations of price returns. Then positioning information, if it is available, like open interest or commitment of traders that we see in US futures markets. The input can also be fundamental in nature. For example, company fundamentals or macroeconomic information like treasury rate or inflation or real effective exchange rates, etc. It can also be non-market information, example, Twitter sentiments, analyst ratings. Next, after the inputs comes your trading rules or logic. Again, the approach can be divided in two clear buckets. The first one is you as a trader with experience in the financial market, you develop hypothesis of what works and what doesn't. So for example, your hypothesis is moving average crossover signals a change in trend. So the next step is basically act on this hypothesis and test it. This is a traditional approach. The other approach is let the data tell you the rules instead of you deciding the rules and test. So the second one is more to do with machine learning and artificial intelligence, especially supervised machine learning. Once you have developed your trading rules, the next thing is to test it. We should be doing both backtesting and forward testing. Backtesting, why? Because that is a very acceptable way to establish that your hypothesis is correct. Forward testing, why? Because not everything you can simulate in a backtest that can happen in an actual market. So what you need a very good platform to guard against biases. What are the biases? Data mining biases, survivorship biases, market impact modeling, and also look ahead biases. So data mining biases is ultimately upon you. So you need to take care of it yourself. No platform can help you in that, but the rest can be taken care by the platform. Blueshift, for example, takes care of this. And also, ideally, the backtesting platform should be flexible because I have seen and I'm pretty convinced that there is no such strategy that works all the time in all the markets. So you will need to change your strategies and to modify your strategies more often than not. And if your backtesting platform is not flexible enough to allow you to do that, then it is probably not going to help you. And finally, this is very critical, and we'll have quite a few slides on this later on, is the portfolio creation. So as I said, not all strategies perform good all the time. So you need a basket of strategies. So do not put all your eggs in a single basket. It's a basic of risk management. But once you have decided that you need a portfolio of strategies, getting the strategy is one thing. The second thing is how to allocate capitals between the strategy. So we'll see a few ways to do that in today's session. First, we'll start with a very brief primer on Python. Why? Because the development in Blueshift that we'll do for strategies will be mostly for Python-based codes. So those of you who already know Python, please excuse me because it will be nothing new for you, unfortunately. So if you go to Blueshift, the first page that you land up is this. So this page lists all the strategies that you have created so far. So we have created so many strategies today, and we'll look into them most of this today. In case you are coming here for the first time, what you will see is that you will be taken to a tour. The tour is a very short way of describing how to use it, how to use the platform. So it says, this is the code area, this is where we code. Then this is the area where we input the parameters for the backtest. The data set is the data source. The start and the end date and the capital are the inputs, how much capital you want to test for what date range. If you want, we can also include a detailed description of the strategies. It becomes very useful when you have quite a few strategies on the platform so that your searching and your internal accounting works better. And finally, if you want a full backtest, that is a backtest along with many other parameters and statistics computed, this is a place to click. And of course, we already seen the strategy page, and we also have the help. So in case you need any help, you can go to the help page, or you can even go to the community page and post your question there. So let's go through a very short primer on Python. First, we'll just create a strategy from a template. So in Blueshift, you don't have to start always from the start. We have set up common algorithms templated already. You can select one, and we can create strategy directly from here. It's already filled in case you are looking for access to this page, please look at the URL, the first part, and you can go there and try to play out yourself if you want to. So the way this platform works is that you type in code in this code area, you hit run, we produce the results and give it to you. The way it works is through 4 different functions. For example, if I select the data set and so we have 4 defined functions that needed for this platform to work. The first one is called initialize, which we see here. This is the function where you set up your backtest in the beginning. And then we have a function called before trading starts. That is called every day before the trading session opens. Then we have another function called handle data. That is called at each of the new price bar arrival. And finally, there is another function called analyze that we can access. So instead of listening to all this, we can just delete pretty much everything here and see how it is done. So first, we'll see that at which point in time all these functions are called. So we'll just print nothing else but the dead time, right? So get dead time is a built-in function for this platform. It's a part of the API. We need to import this. The second function, as I said, is called before trading start. It takes a parameter called context and another parameter called data. We'll talk about this parameter later, but for now, we'll just see that what is the calling order of this. The second function is called handle. Third function is called handle data. This also takes the same parameters. We'll also have a print here. And finally, as I said, the last function is called analyze. It takes context as well as something called perf. We'll talk about what is it. Just for a better visualization, we'll move to a particular, we move to the minute data instead of daily data. So for example, I choose yesterday's data. We have a syntax error, which is now fixed. So our thing has run. So if we go and see the output, we see that the initialize was called on the first day. So on the first timestamp on the day, that is midnight, on 27th, we call this function initialize. Before trading start was also called on the same day before the start of the trading day. This is Indian timestamps, so 8:45 a.m. In India, NSE market opens at 9:15. And then for every minute, starting from 9:15:59, we are getting this handle data called. And finally, at the end, we have this analyze called. So this is the calling order. So all your code has to do is to figure out in which part of these functions you need to put your code in. Now, those of you who do not know about Python itself, we'll do a very brief introduction. So for example, starting with the print statement. So for example, if I say print hello Blueshift, and I run it. To run, you can use a keyboard shortcut, which will run it from. So this is how we print in Python. There's a simple one-liner. The variable types in Python are very simple. So for example, we assign variable with an equal to, and we have string types of variable. This is an example of strings. We have integer variable. This is an example of integer. If you put a period, or if you put a decimal point here, it becomes a float, and we can print in the same manner. For example, we run it again and see what is the output. So as expected, the answer to the life universe and everything else is 42, as all of us know. And then there is another important data structure which is very useful. It's called dictionaries. So for example, I have defined a dictionary with key and value. Key value pair maps up the dictionary to a particular key to a particular value. We can access the keys through this function on the dictionary. We can access the values through this function on the dictionary. And we can print the keys and the values in the same manner. Also, a very brief on the list. So for example, we can use list in this manner, and also we can define function like very simple function like this. For example, the keyword is def. We define the name of the function, we define the argument, and we just define a return value. Why I'm going through this Python details is that for those who doesn't know, we'll go through some codes, and it will be quite Greek to them. So if you are this much familiar, it will be enough to catch, right? So here we decide. Here we define a list with 3 elements. Name of famous Jedis, and then we can iterate through the list using a for loop. We can call the function using just the function that you have defined here. We can call passing variables here. We can also use an if clause, for example, to compare the output of the function, the return value, with what it should be. And also, very, very briefly, the way we define class in Python is very simple. It's just like defining a function as such. So we need to define this init method that defines how the object belonging to this particular class will be will be constructed, and then any methods and the variables that the function that the class may need, we define them. And to create those objects in the main function, we can always use the class name and parenthesis, which calls the initialization function init here, and then we can call any function like this. So for example, if we run this entire thing, the expected output is that we see this printed first, then we see all the houses in the Harry Potter world in Hogwarts and all the founders of the Hogwarts. Then you also see this key value mapping properly. Then we see the famous Jedi's name. Then we check our knowledge in maths. Then we create Anakin Skywalker object, and then we make him confess. So this is how it is. We have already seen this far. This is it's printing as expected. And also, as we see that once we created that Anakin object, it called the init and printed this. And then when you called the confess function, it printed the expected output. So this is very brief Python primer. This is no ways enough for being a Python programmer, but it is more or less enough to be able to code on this platform. Okay, fine. So we'll go back to our thing here. So on the Blueshift, the workflow, as we just seen, is mostly concentrated in 4 steps. We are not showing the final steps here, the analyze function, because it's not always used. So it boils down to 3 steps, which is initialize, before trading start, and handle data. The other useful API functions that we should know about is first, schedule function. We'll see the example of a schedule function later on. The second one is ordering functions. So ordering functions are mostly of three types. One is order percent target, that is given your, if you remember, once you have developed your target portfolio, the weights, so given your weights, you can just use this function to order your, to take positions in those underlying assets in the weights you have computed. And then the second useful function is get open orders, which gives you the number of orders that are yet to be executed. And then cancel order, of course, to cancel the order. And the final set of useful functions are controlling your trading environment. For example, set commission sets up the structure, the commissions that your broker will charge you. Set slippage set up the environment to compute the slippage that your trading will do. And set account currency sets account currency that you want to compute your PNL in. This is not very relevant for today's session because today we'll mostly concentrate on equities. But if you're trading Forex, then of course this becomes very important. Fine. As you have seen that in Blueshift, most of the functions we defined there had two parameters, one called context, the second one called data. The context is the function that captures the entire state of the algorithm, and it has the trading calendar, for example. It has your account information, it has your portfolio information. It can also hold any sort of variable you want to store and make available across the strategy. The last point is very, very important, and we'll see how we do this. On the other hand, the data object is your access to your portal to the data that is already built in on the platform. So you can call data.current function or data.history function to fetch the current data. For example, we go back to the site again. We have this thing. Let's create another new function just for testing. Let's say test2 and create a simple buy and hold strategy. And let's see what the data looks like. So for example, in rebalance function, we have these two parameters. Let's see what inside this context. So if you want to access your portfolio, you can simply print context.portfolio. And if you want to access some data, so for example, if I want to access price for a particular symbol in the universe, I can simply say history, that particular symbol. And we need to tell what is the price we are looking for. So for example, if you're looking for close price, how many bars you are looking for. So for example, for 10 bars only, last 10 bars. And what is the frequency? For example, you're looking for, say, 1 minute frequency. And then we just print the price. We'll run it for a very short period of time just for the demonstration purpose. We'll again go back to the start of the last month, maybe, and end of this month. So we run it. So here is one more thing to notice here. Is that we have used something called schedule function. I promise that we'll look at it. The way it works is that this is an API function that calls another function, in which case, in this case, this is a rebalance function, and it defines when to call in terms of the days as well as the time. The days here, you're using month start. It can be week start or month end or weekend. And offset defines the offset. So for example, if I have month start and offset 2, that means 2 days after the start of the month. The time rules define what is the time of the day it should be called. So if it is market open 2 hours, 30 minutes, that means it will be called after the market open after 2.5 hours. Anyway, coming back to here, so let's see that how things got printed. we see that our portfolio printed in this manner. So it's got a value of the portfolio. On the last day, if you see, it's got a value of portfolio, it's got a position exposure, it got the amount of cash you are left with. We started with 10,000, we're left with this much. The rest has been traded as purchased, used to purchase stocks. And then this is the data that we printed. So we got a data against each timestamp as a pandas data series. If you use multiple symbols here or multiple fields here, for example, open, high, low, close, then you'll get a data frame. If you use both multiple symbols and multiple fields, then it becomes a panel data. We'll see an example of that as well. So anyway, so now I hope that you guys are mostly familiar with, you got a hint of the idea that how we can access data and what to do with the context object. Now what we'll do is we'll make a useful template that we can use over and over again. The usefulness of this is it's a one-time effort. It takes away all the boilerplates code generation, and we can use it later anytime we want. So what we'll do is that we can start with the same thing. We don't need this rebalance function, so I'll just delete it. We'll keep this import, but we'll add a few other imports. So we'll need this import for our technical indicator based functions to work. The first one is tlib. It's a very standard technical indicator library ported to Python. And then we have the standard libraries for pandas and numpys. The last one, bisect, it is used for calculating support resistance, Fibonacci support resistance based indicator. For this particular case, we'll not even be using it. Anyway, so then what we'll do, we'll leave this zipline import here. We'll be using the set commission and the set slippage functions. So we'll just import them quickly as well so that you can use those functions. Fine. We'll keep this as intact. We'll not be using all of them, but this is a block, so there's no need to modify this. Next, what we'll do is that we'll reduce our universe so that things run fast. So we'll just use the Nifty first futures and the Bank Nifty first futures in NSE. Those of you are not familiar with NSE, these are the two major indices that are available on NSE FNO segment. I see that there are some issues with my screen sharing. It shows that the screen has not reached everyone. So I'll just take a pause here to make sure everyone catches up. Anyway, so we'll continue. So anyway, so we just reduce the universe to only two instruments. We'll rename this as universe. It's not a long portfolio anyway. As I said, we don't need the schedule function, so we'll delete it. What we'll need is that, as we discussed, that we can add any variables we want to make available across these four functions in context variable itself. So we'll add a parameter variable in context. Now, we just gone through dictionaries in Python, so this should be a familiar thing. This is just a dictionary stored as a params variable under context. So we are basically storing all the parameters for our strategies in a single place, so that if you want to make any changes, we need to make changes only in one place. So this is our indicator look back. These are some threshold for buy and sell. These are some periods for our fast moving and slow moving averages, and RSI and the B-band periods and ADX periods. Not necessarily you will be using everything all the time, but it's easy to keep a standard set of parameters so that we can change. The last one is trade frequency, not the last but one. This basically means how many minutes we actually trade. The Blueshift platform gives you minute level data. So the maximum frequency you can trade here is in the backtest is 1 minute. But if you do not want to trade 1 minute, if you want to trade say every 15 minutes, we'll see that how we can do that. So this is where we put that number. So 15 here means we'll trade only 15 minutes. Then we'll add a variable to control this trading that we just discussed. We'll see that how this variable can be used to control that. We'll also create a weights portfolio for each of the instruments of our universe, and we'll initialize it with 0. You see 0 here. And then we'll set up the commissions and slippage here. For demo purpose, I'll set them to 0. And finally, we are done more or less. What you need to do is that next we have to define the other functions. So before trading start, context and data, we are not going to really use this function, so we'll pass it. Then we have handle data. This is the function that we need here. So what we'll do is that we'll quickly make sure that this handle data works the way we intend. That is, we'll be trading every 15 minutes. So to do that, we put this condition. What this condition allows us to do is that if it is only multiple of 15s, the minute number, then only we'll enter the functions. Otherwise, we'll just return null from the function. And to handle the case where we have actually entered to trade, so what we do is that we just call this function run strategy. Now that this function will be our main function to run our strategy. So obviously this function needs to be defined. All these functions that you want to define should take these two variables, at least the context variables, so that your function is effective in passing around data. So round strategy function is very simple. We just call the prices, the past prices on our universe of stocks we have selected, futures in this case, and then we compute the weights, and then we just rebalance. So the way it should look like is something like this. So we are calling the context.universe prices, all the price values, open, high, low, close, for the period of indicator look back. If you go back up, we see indicator look back is 375. So 375 is 375 minutes. And then we see indicator frequency. If you go back, indicator frequency is 1 minute. So we are asking for 1 minute 375 bars for WHLC for all the instruments in our universe. And then there is something here which is context.advisor.compute signal. So if you remember, we are talking about this. So we have selected our universe. Now you're selecting our signal generation. So this advisor is an object that we'll see how to create, which will do the computation of the signal for us. And once we compute the signal, we assign that advisor weights to our current weights, and then we call the rebalance function. So since we have a rebalance function, we have to implement the rebalance function as well. The rebalance function will be relatively simple. We'll just loop through all the securities in our universe and place an order to achieve our target weights. So this is where we are talking about here, the rebalance function here. Now that we have defined, we can also add an analyze function if you will. So for example, I'll just add a standard analyze function that basically print your context portfolio at the end and also the weights at the end of the backtest. Now that we have done this, now we have to define this main thing here, which is this advisor thing. So to do that, first what we need to do is we need to add a variable here, which will be the object for computing the weight. So right now we don't know what it is. We'll set it at none. We'll do how to do it later on. So first we need to define the object here. So we'll define a class called advisor. As we know that the class will have the first method is init. This init method, so for this advisor class, we want to give certain inputs. The inputs that you want to give is a name for this advisor, which will be a text, signal function for this advisor, which will compute the buy or sell signal in terms of +1 or -1 or flat in terms of 0. And then you'll also want to pass on our stock selection universe so that it knows what to do for each stocks there. So it will look something like this. And if you want to define the things inside, we'll see what we are trying to achieve here. The first is, of course, we want to keep a number of asset tag. Then we want to store the name and the signal function as well. And also you want to store the last and current price as well as the last and current weights. Why you want to do this? Because we want to store the performance of this advisor. We'll see how this comes in handy later on. So we initialize the performance at 100, and then we store the last and the current price and initialize them all as 0. Then the next thing is we have to define this main function that you're using here. So for example, where we use this compute signal. So you have to define this function. This will be the function that will take all this information and call the signal function to generate the signal. So this will take into account the universe and the parameters that you have stored in the context and also the prices that you have just received. So what we'll do is that it will just for each securities, it will get the prices for the securities, call the signal function, and once it got the signal output from the signal function that we passed on while creating the object, and then based on that value of the signal, we'll decide whether we want to buy or sell and put a sign on the weight accordingly. The weight is initialized with the same value for 1, so that so it sums up to 1 for all of them together. So once you have done that, then finally we'll also want to update the performance of the advisor as well, so that we can track how much profit and loss it's generating for us. So we'll just call another function. Of course, that means we have to define this function as well. This will be a very simple function. So what we'll do is that this function is basically going through the last weights and computing the price change between the last and the current price that you have stored while defining the thing, and then compute the performance based on the percentage change in the last and the current price weighted by the respective weights, right? So this is how it is. Now what we need to do is we need to go back to the place where we set advisor as none and make it a proper advisor. So we need to put a name. So let's put agent 1 or maybe expert 1, and then we need to put a function. We haven't defined the function yet, and then we need to put the universe as well. So it will be context.universe. Now we have to define the main function. So today's strategy is based on technical indicators. So before we define the main function, let's look at the technical indicators part. Technical indicators are usually a transformation of the past price. Most of the technical indicators can be expressed as a weighted function of the returns. So for example, there's a couple of very good theoretical papers, especially from Cliff Asness of Equal Capital. You can have a look at them. It is highly knowledgeable, so I'd suggest that. Major categories of technical indicators, if you think in terms of their statistical properties, they come in three flavors. One is indicators that are linear function of the past returns, like moving averages and MACD and commodity channel indicator, so on. Then there are some functions which are there are some indicators which are functions of not the value of the returns as such, but the sign of the return. For example, RSI is a prime candidate. And finally, we have another very few indicators which are not even sign or value function, but rather time function of returns. Prime candidate in this category is Arun oscillator. Those of you who do not know Arun oscillator basically tracks the time from the peak to trough for a particular security. Now, the thing about technical indicators is that they're usually correlated. Of course, because most of them are based on the same data, which is the price. So they should be correlated. If you do a statistical analysis of them, which is commonly known as principal component analysis, you will find that the first component of this, the first common component of different technical indicators, it points to the current momentum and mean reversion in the market. But the second and third components are typical to the idiosyncratic to the particular indicator. They differ in terms of their time series characteristics, especially in terms of their frequency response. So all these technical indicators can be thought of doing some sort of filtering on the past prices or past returns. So whether they filter the high frequency data or high frequency returns, or whether they pick up the long-term trends or the short-term trends. So based on those characteristics that differ a lot in terms of their frequency response. Now, a very good reason to use technical indicators is they can be a self-fulfilling prophecy. They can benefit from there. For example, imagine a market where everyone is trading moving averages. So if a moving average, short-term moving average crosses the long-term, everyone buys, so the price goes up even further. So some more people buy and goes up even further. So it continues. So if everyone follows the same indicator, it makes sense that it can benefit from self-fulfilling prophecy. And even if it has got nothing to do with predicting power, it can still be useful in terms of making money. On the other hand, they can suffer from some certain categories of predatory algorithms. So for example, momentum ignition, stop loss hunting. We will not go into details of those, but especially if you are trading with technical indicators in a high frequency manner, you should be very, very careful. Finally, if you have a very strong momentum and mean reversion regime in the market, and if you're using the correct technical indicators, so for example, you're using a momentum crossover strategy for a strong momentum market, your strategy is guaranteed to perform. But if your momentum indicator shows that there is a momentum in the market, it is not guaranteed to be correct. So if the market is in momentum, your signal will work. If your signal shows momentum, doesn't mean that market is in momentum. So there you also have to be careful. And this is where having different indicators and having a portfolio of different indicators comes in handy. We'll see that later. So the strategy is very simple today. We just have a Bollinger Band. If you go very lower to the lower band, we buy, go up very near to the upper band, we sell. If you are in between, we basically switch from Bollinger Band to moving average crossover, and we just trade based on the short-term moving average crossing the long-term. Now, if we try to code this on Blueshift, it's very, very simple. So for example, let's code the function. We call the function as expert advisor. Those of you are familiar with, say, for example, um, all of you know what platform use expert advisor, I hope, EA. So we'll call this EA as well. So what we're doing is we are calling a function Bollinger Band, which returns the upper, the mid, and the lower bands. And we are also calling a function called EMA and giving parameters for the long-term and the short-term look back for our long-term and short-term moving averages. And based on this is the distance to upper is too close, we short. Distance to upper is too far, that is too close to the lower, we go long. And in between, we trade the momentum. Now we have defined this function, so we have to add this function. So what we'll do is that instead of adding only this function, we'll add a whole bunch of technical indicator function. This is the reason why we imported this TA library. So this is a list of technical indicators. So this one, for example, is calling the library function called SMA, capital SMA, and returning the last value in a convenient way. While the function that we're using today is the Bollinger Band. It's calling the library function bbands and returning the last row. Similarly, we're also using EMA. We have many other functions like RSI, MACD, Doji is candlestick pattern, and then we have ADX, you have Fibonacci, support and resistance. The last one is not part of TLib. This is what I wrote. So once you have this, now let's give it a shot how it runs. It may fail, which will mean that I've made some error in the coding, but let's give it a shot anyway. Yes, of course. Line 80. There's blank here. So we should pass on the function name here. So we put the function name here. We forgot to do that. So what is happening here is that we have some more. Yes, so we are using a function called get price here, and we forgot to define the function, so quickly define that function as well. Get price function will get the prices for all the securities together and filter that based on a particular securities that you ask for. So it has all the prices and the particular security we ask for. We try to retrieve the function in two different manners. This block will execute if the function is a pandas data frame, and this block will execute if the function is a pandas panel data. In our case, it will be panel data. So the way it works is that for each period, we see that whether it is time to trade. You remember this particular, see, we are not getting into any trades. So it's all flat. The reason it's all flat is that, let me cancel the trade run and refresh the page. The reason is all flat because we are trading Bank Nifty and Nifty, and we only have 10,000 in our account. So our algorithm doesn't have enough money to buy any one of them. So let's increase the account value and then run again. Well, so now hopefully it will run. So the way it works is that at each point, at each data, we call the handle data function. We see if it is time to run, time to trade. If it is time to trade, we come here, we execute this function called run strategy. Run strategy basically asks for the prices for that particular time period, and then call this advisor compute signal price function with the appropriate arguments. This compute signal in turn computes the weights that we should be trading. Once we know the weights, we call the rebalance, which loops through all the securities in our universe and place an order to achieve the target percentage. And then finally, of course, we do the analyze thing. We'll see that. So here, the advisor is basically used for computing the signal, which is again, based on the function that we took on while creating the advisor called signal function. So based on the signal function, it creates the signal, and based on the parameters, whether it's beyond or by or cell threshold, we call that signal function. We define the target weights. And also, it is very important not to forget that we also keep a track of our target. Now, going back. So this is a very simple strategy. If we can do this strategy for many different things. So for example, I've run this strategy for a bunch of different arrangements. So we have a case of Bollinger Bands, then we have a case of moving average crossover, we have a case of Fibonacci support and resistance, candlestick pattern as well. So all these strategies are performing decently. One of the reasons they're performing decently is, of course, because this has been a very good period for the equities itself, in especially Nifty and Bank Nifty. So please keep that in mind. So they're performing decently, but let's see that if we can improve. For those of you who are wondering about the code, do not worry. All these codes will be available in our GitHub account. We have a GitHub account to share this demo strategies and templates. There are a lot of there. These will also feature there, so you can always go back and pick it up from there. Do not need to focus too much on that. Just try to appreciate the flow. I think that will be of immense help. Now, the second part that you're coming here is about managing strategy portfolios. So as I said, that all the strategies are performing quite decent, but this is probably because of a very good bull run in the equities, and it will not for a different period. So one way of improving your strategy or your algorithmic trading profit is, instead of running a single strategy, run a multiple of them, either multiple strategies simultaneously or different strategies in different period of time in a serial manner. The choice is yours. So so few ways of managing strategy portfolios. The first one is about creating a committee. So a very crude example of creating a committee is taking an average. So for example, we have 4 strategies. Each one of them tell us what to buy, what to sell, and then we take an average of all the buys and the sales signal, and based on that average, we make the trades. That is one way of doing it. We can do many other things, like we can take a vote, for example, and if all of them agree on buying and selling in the same direction, then only we trade, otherwise it go flat. The second one is regime switching model. Regime switching model, if you remember from the strategy space, we said that this is of Quant's favorite models. So we have not demoed it, but if you go, I think in our Forex section on the demo strategies, you may be able to pick up a regime switching model, not in today's session. Then another one is dynamic allocation. Dynamic allocation is based on each expert advisors that you're running, each strategy that you're running, you are tracking their performance. So the reason you're tracking the performance is that you want to see which is performing. You allocate more money to that person, and whoever is not performing, you take money away from them. And you do it algorithmically. This is one demo that we'll see today. And then finally, which is again a quant favorite, is factor-based investing. Here, what you try to do is that you run different strategies. You try to isolate the factor exposure, the so-called risk factor exposure to each one of them, and then you build your portfolio based around your desired exposure to each factor. Or if you want pure alpha, you can actually trade out the risk factor and keep only the alpha component. Of course, that assumes that your strategy will have an alpha component. Why the committee of experts works? This is mostly because when we take average, it improves our signal, not by being more accurate, but by being more stable. So those of you who are already familiar with machine learning, this particular equation will look very, very familiar to you. So here we are not improving the accuracy of our strategy. We are basically increasing the stability of our strategy. So let's quickly see how the strategy is coded. We go back, we click the correct strategies. So this strategy is exactly what we have done so far. There is only one change. The change is that previously we had only advisor. Now you're adding a trader as well who will do the capital allocation between this advisor. So we have already seen this class before. We are adding another class here called agent. So the agent is responsible for choosing advisors and allocating capital. And how it does? So for each time you want to update the weights of a particular advisor, it calls its own weighing function. And based on the output of the weighing function, it set the current weights for each of the advisor. And if this current weights are set, then in the rebalance function that you have seen, that current weights is taken into account to normalize the output of each of the signal from each of this advisor. This weighing function is totally up to us, how you want to weigh. So for example, here what we are doing is we are defining the weights as 1 divided by the number of advisor, which means it's an equally weighted portfolio. And this also updates the P&L history of each of the advisor so that it can, if needed, it can take that into account, the performance of each of this advisor into account to compute the weighing function. Of course, in this particular case, we are not using it because we are using equal allocation for all of them. But if needed, we can do that. We'll see an example of that as well. So this is our only change that you have done. We have added a new class that will take care of capital allocation between these advisors. So obviously right now, the last example, we had only one signal function and only one advisor. Now we have advisor 1, we have advisor 2. Advisor 1 is the same. Advisor 2 is something based on moving average crossover. Then we have advisor 3, which is based on, again, candlestick pattern. No, actually, it's not candlestick pattern. It is, yeah, it is based on candlestick pattern, doji and Bollinger Band. Then we have another advisor which is based on the Fibonacci support. And what you're doing here is that we are creating all these expert advisors separately. And then we are creating an agent, passing him the list of these experts and asking him to do the allocation. So I've already run a backtest on this. We can run the backtest here as well. So this is quick backtest. Quick backtest gives us a quick output, but also to make it quick, it gives us only a limited set of outputs. So as you see that you can only see the overall headline returns, the cumulative returns, the alpha and the beta, they are in percentage, not shown here. And also the Sharpe ratio. Those of you who do not know about Sharpe ratio, I strongly recommend go to the Wikipedia page and read about it. And then also the drawdown. Drawdown is a very, very important component of your strategy. If your strategy has a fantastic Sharpe but very bad drawdown, you probably cannot trade that. We'll not wait for this backtest to complete. It will take some time because lots of computation are going on. So we'll go to the backtest page. From quick run, whenever you switch away from this page, that quick run is destroyed. But since we have already stored the backtest, it's not a problem for us. So we'll see that how the overall things look. So the overall things looks much better. So if you remember that last time in the average case, in the individual cases, we had something like 1.55 to 1.16 to something like 1.99 range of Sharpe for different strategies. Now you're straight back to quite an improvement. This is just because doing nothing else but averaging, and by averaging you are reducing the variance of our signals, by reducing the variance of signal, making it more stable, we are improving our performance. Hopefully this will work even when some of the strategies, underlying strategies, is not working. And also it gives you a bit more information about the backtest. So for example, the Sortino ratio is a very interesting one. You should look at it more. Stability of the time series is another interesting one. That is my favorite. It basically measures that how this profit and loss curve is compared to a straight line. If it is almost following a straight line, it's very good. If it is not, that means your most of the profits is concentrated in a few big trades, which is not probably a very good way of investing systematically, because you may not get lucky. Probably you got lucky in those few trades. Here also, if you want further information, you can see the your details like what has been your gross leverage over the period, your strategy vol. We see that vol goes up marginally. You can also see your strategy distribution, return distribution histogram, your monthly performance, your drawdown. If you are interested, you can also get into the individual level transactions, and there are error logs as well. We gives you some algo warning where the algorithm fails to execute full amount of your orders. Here are, for example, some. Um, but the main thing is that just by giving this simple equal weighted averaging portfolio, we have improved our performance quite a bit. But that is not all. We can do better. Um, the one we can do is that so equally weighted portfolio is good if you're it is good here in this case because we have a fantastic equity bull run, so most of them worked, so the overall portfolio worked as well, and giving that averaging, we also reduced the variance, so our overall Sharpe improved. But if you're not that lucky, then probably you need a much better way to do this weighing. So here is one way of doing this. This is called no regret trading. You can learn, you can check out the no regret learning page on wiki, or there are many papers. I think there are a couple of links here as well, so you can check. So it is like, so for example, the picture you see, there are some 4 slot machine. You have four strategies. There are 4 slot machines. You don't know which one performs better because you cannot predict future, but you assume that they somehow capture the market trend, and they don't flip very fast. So something that was doing something consistently, they remain consistent. So if it is losing, they will keep on losing. If it is winning, it will keep on winning. That's your underlying assumption. And if you do that, then basically what you do is that you try to vary the weights for each of this, and try to see that which maximizes your expected outcome. So one of the algorithm to do this is called exponential gradient algorithm. So we specify a particular parameter called learning rate, and if we increase the learning rate, then we basically become very greedy. We basically put most of our portfolios to the best or the winning algorithm and make everything else, all the other 3 0. And if you put the learning rate small, then basically we play safe. We put a high penalty on switching large amount of money from one advisor to another. So we need to play with that parameter, and then we fine tune based on our market scenario, and we can use that to create a strategy. So for example, let's see the strategy here. We go back here. So this is the strategy here. The changes here in the strategy is nothing but only one place, which is, as you might have guessed, is in the weighing function. So this weighing function was much simpler last time. It is a bit more complicated here. So what you are doing is that in the weighing function here, we are not only taking care of the current weights and the advisors, you are also taking into account the performance of the advisors. And you are computing the returns for each of the advisors in a for loop. And we are computing the volatility of the advisor as well. We are taking a ratio of that, which is effectively a Sharpe ratio. And based on this ratio, we are adjusting incrementally the weight it should be. For example, if you see the backtest, we see that the performance is not bad. We see that it's slightly smaller than the averaging portfolio. That is purely because it was a bull run and the average portfolio performed better. But in a more adverse scenario, this is expected to perform much better. If you see the output log, we are also printing the weights for each of these underlying strategies. We see that we start with equal portfolio, and then it suddenly starts changing, and more and more money get allocated to the one that works more. So for example, in the final allocation, somehow all of them performed more or less similar, so we are very close to the equal weighted portfolio allocation. But of course, this is not the only way to do this. We can also use some other variations. So for example, a favorite way of allocating capital is called the Kelly criteria. So again, the Kelly criteria is very simple. The only difference is that the weighing function. So before we are doing the return versus the volatility, now you're doing return versus the variance. The reason we do return versus variance, if you are again interested, please go through the Wikipedia page. Return versus variance is done because of the assumption of a geometric Brownian motion, where return minus your half sigma square is your expected geometric return for a period. So that's why we try to maximize our expected return. That's why we take this metric. And again, we can do this. Now, if you see the backtest here, again, we'll see that the performance is comparable. Again, the performance comparable because it's been a very, very favorable market. If the market is not favorable, it will be, it is expected to perform better than average weight. And also you can see the output of the weights. We see that the output of the weights is, in this case, is much more variant. So for example, the first advisor got almost 30% allocation, whereas the second one got only 20%. A very interesting thing to do is that to check whether this really works. So for example, we have 4 advisors. Let's make the first 3 of them random. So let's call this numpy function called random to generate a random number between 1 to 5, and based on if this number greater than or equal to 5.5, we'll generate the signal. So say if the number is greater than 1, we say 1. If the number else less than that, we say sell. So it is absolutely a random signal, right? So it should not perform. So ideally, this signal should get, this advisor should get less and less allocation compared to others, which does. So here also we make it random, and this one also we make it random, and we only keep this one as a proper function, right? Now if you run, let's see how it works. So again, the functions here are doing the same thing. It's basically each of these advisors computing the signal, and then the agent, the allocation agent, is excuse me, is computing what should be the performance allocation based on their past performance of each agent, and then doing the allocation. And once you finalize your target portfolio, then the rebalance function, the main rebalance function, takes care, and it orders the targets. We'll wait a few minutes here for the backtest to complete. As I said that there are lots of computation going on here. These are mini data as well, so it takes a while to complete. We can take this moment to actually look a bit into the agent function. So agent function is basically taking this list of advisors here. Then it's also taking a learning rate parameter. This is the parameter we decided, we discussed that we need to tune. A large, this should be between 0 to 0.5. A large learning rate means we are being greedy, and a small learning rate means we are being very, very cautious. And then it gets the compute weight function, which basically calls the advisor compute signal in turn. So if you see here, it loops through the advisors list and call the advisor compute signal and club them and add them up security wise, and then send it back to the context weights, the main weights. And then finally update weights we've already seen, that calls the weighing function. Our backtest is completed, so we'll see how the weights has been doing. So if you see, we start with 0.25, and if we go down below, we see that all this 2 has been allocated 0. This is also a random signal. For some part, it has performed good randomly, so it's got some allocation. And this is a real signal, so it got a allocation anyway. So this part is this is thing to note here is that if you're running it for a short period of time, here we have run it for 1.5 years, so it may get some allocation, but over a long period of time, a random strategy will ultimately end up with 0 PNL, and it will also go down just like it other fellows, 0. So that's it mostly. So just take a look back. This is how the strategy portfolio performance looks like, which are all of them are very similar and much better than the individual strategies. A few guidelines on the strategy development. Do not overfit, do not overfit, do not overfit. And also check the account leverage. It is a very important function. Schedule function we have all talked about very little. I'd advise to explore more on this. It can make your backtest run much faster. And finally, the list of demo strategies here. Don't forget to check out the examples under equities and the Forex as well. Today's strategies are under the folder called portfolio. So that brings us to the end of this session. If you have liked what you have seen, so Blueshift is a place where you can do all this. And before you can actually do that, you need a platform, but you also need the knowledge. In case you are looking for that knowledge, our flagship course called EPAT is a very good course to start with. Will this session be recorded? I believe it will be recorded and shared along with the this presentation material, and also you can access the strategy material directly on GitHub. It's already shown the link for the GitHub. Um, does Blueshift support Escalon, TensorFlow, PyTorch, Keras, and other deep learning Python packages? No, unfortunately not. Right now we are supporting only Escalon, the TensorFlow, and the others. We don't plan to support PyTorch. By the way, TensorFlow and Keras are not competing things. Basically, Keras is a high-level interface. TensorFlow is more like a backend. So people typically use TensorFlow as a backend with the Keras as a high-level interface. We plan to support that, but that will take some time for us. We are not planning to support PyTorch. Are you planning to start asset management like Quantopian? No, not at this point in time. The answer is at this point in time, the answer is no. How do we forward testing? So there are two ways of doing forward testing. One is what is called paper trading. That is, you actually code your strategies, backtest, you see that it works, and then you try to look for a platform where it allows you to trade the strategies without risking live money. The second thing is to allow a small amount of capital to actually test the strategy in a live market. The second one is preferred, but of course, not everything can be done in the second manner. For example, if you're trading 50 stocks at a time, which requires a huge amount of capital to do even one lot of trades each, then it requires considerable amount of capital. Is the backtest confined to Indian markets? No, not at all. You mean the data set that we have data set for US and India for equities, and for FX, of course, it's global. In case of access, there is no restriction. As long as you have an internet connection and our server is up, you can access it. Our service is up most of the time, by the way. Can we use Jupyter Notebook? No, we haven't yet incorporated a Jupyter Notebook interface on this. We are planning to do this, but again, that will take considerable time. Is this API compatible with Zipline and Quandl? This is based on Zipline. It is heavily modified, our own modified version of Zipline. But I'm not sure what you mean by Quandl. Quandl is a very different thing. Quandl is for fetching data, not much to do with backtesting. Can you connect to NSE and trade live through Blueshift? Not yet. We are working on that. Have you tied up with any brokerage? No, not yet again. We are again considering that. For rebalance to work, does it sell off the position to buy everything from the start? No. So the way it works is that it trades the incremental change in position. So for example, today you have only two assets, you have done 50-50. One asset has rallied in price. That means it has got a value greater than half of your portfolio because it has appreciated in value. So what you will do is that you will sell that asset a bit, and with that money you will buy the other asset a bit more. So it is kind of a mean reversion, as you can see. So this is what a constant rebalancing portfolio looks like. What sort of debugging tools are integrated with Blueshift? Unfortunately, do not have any debugging tools. We still have the old one, which is called print statement. My apologies for that. We'll definitely look into this to come up with something better. Can the validation of strategies written can be backtested for Nifty and the Bank Nifty options? Unfortunately, we do not have options data incorporated yet. It is fundamentally difficult to create a reliable option backtesting platform. We're trying to solve that problem. So you may hear positive news from us in future. But most of the platform that will offer you option backtesting are usually very unreliable, or it is too much of data cleaning and data arranging that you have to do yourself. So Indian derivatives, we only support futures, the first futures, which are the liquid futures in the market as of now. Can you get a data feed from a third party? No, we do not allow any third party data feed. What should be the minimum recommended for time period? It depends on your trading frequency. For example, if you're trading, say, 20 times a day, even a month of trading is enough. But if you are trading, say, once every week, probably you have to run it for at least a year, and by which time your market characteristics may even change. So this kind of things will work better if your trading frequency is higher, so that you have more confidence that your signal is proper. On the other hand, the downside of it is that if your trading frequency is higher, you end up paying more commissions to your broker as well. Do you have 1 minute data for Indian markets? Yes, we have 1 minute data for Indian markets covering all the FNO stocks. That is the cash as well as the first features. We also have daily data for the Indian markets covering all the stocks under Nifty 500. We do have commission. Yes, this is intraday, and we do have commission function. We haven't spoken about the commission and the slippage model, but if you're interested, please refer to our database. If you have any questions, I suggest that you put a comment to our community link in the same site. We'll be glad to get involved. Someone has asked on the optimization runs. Yes, this is one of the drawbacks we have right now. We do not have a very efficient way of running optimization. One of the reason we do not have is that we are not yet developed the technology to do that. The second reason is that I honestly do not prefer running optimization runs. So basically, we do not want to optimize our parameters to our backtest returns. We want to optimize our parameters to our live expected returns. So that is probably a topic for another day. What is the fees for using Blueshift? The good news is it's free. Okay, so I will leave the mantle to how many scripts you can backtest parallelly. No, sorry. So we do not allow a parallel backtest as you. I'm not sure what you means if you are talking about running different backtest and integrating their results, which is typically mean by parallel running. We do not support that. But if you by parallel means running multiple backtests, separate backtests at the same time, so that depends on our website traffic. So if website traffic can accommodate it, then there is no restriction as such from our side. Can you do ADF testing for pairs? Of course you can do. So you can do pretty much what you can do with Python in your computer, provided the packages are made available in our platform. There is a restricted list of packages which are available, obviously for security reasons. And in case you guys think that there are other packages out there which need to be considered, please drop us a line. We'll be happy to take it up. And Scikit is supported. Sincere thanks from my side for attending this session and being patient with me. Good luck, guys.
Thank you, Pradipta, for your nice presentation, wonderful presentation here. I think a lot of them like this, seeing the number of questions that we have received. So again, I would like to thank you all for attending this webinar. This was totally keeping in mind the interest that you all have. So have a good day ahead, and look forward to speaking to you all soon. Bye-bye.